Have you ever wondered how businesses measure their financial performance? One crucial tool that holds the answer is the income statement. Also known as the profit and loss statement or the P&L, it serves as a window into a company's financial world. Today, we're diving deep into the realm of the income statement to unravel its significance and learn how it reveals the story of a business's revenues, expenses, and overall profitability. Get ready to explore this essential aspect of financial analysis and discover the secrets it holds about a company's financial well-being. Unlock the secret to financial success with Kountin Koins, where numbers come alive and your accounting game thrives. So what exactly is an income statement? Well, it's a magical document that summarizes a business's revenues and expenses over a specific period of time. It's like taking a snapshot of a company's financial performance and turning it into a captivating story. Imagine this: if a balance sheet is a frozen photograph capturing a business's assets, liabilities, and equity at a single moment, the income statement is like watching a riveting video clip. It covers a defined time frame, starting from the beginning and leading us to the grand finale at the bottom line, where we discover the profit or loss. Now let's take a closer look at the structure of an income statement. It all begins with the glorious total revenue earned by the business. This is the sum of money generated from sales, services rendered, or any other income sources. From this mighty revenue figure, we deduct the expenses incurred during the period, such as cost of production, salaries, rent, marketing, and all those financial dragons that businesses must face. Once the expenses are subtracted from the total revenue, we unveil the treasure hidden within, the profit or loss. It's a thrilling moment as we discover whether the business triumphed with the profit or stumbled upon a loss. And that's precisely why the income statement is also referred to as the profit and loss statement or P&L. It reveals the triumphs and the setbacks, the victories and the challenges faced by the business. Now let's talk about time. The income statement covers a specific period, which could be a month, a quarter, or even an entire year. It's like exploring a thrilling chapter in the book of a business's financial life. And just like a gripping story, it leaves us eager to find out what happens next. Additionally, the income statement is not alone in this financial adventure. It has two trusty companions, the balance sheet and the cash flow statement. Together, they form the holy trinity of financial statements. While the income statement tells us about a business's profitability, the balance sheet reveals its financial position at the given moment, and the cash flow statement illuminates the inflow and outflow of cash. Combined, these three statements provide a comprehensive view of a business's financial health. Now let's dive deeper into the mystical depths of the income statement. It's not just a plain list of numbers, it's a world of details waiting to be explored. Instead of a mundane layout, it's much more enlightening to provide descriptive details. For example, when we mention revenue, we can specify its different types, like product sales or services rendered. This additional detail helps readers understand the nature of the income more clearly, making everything crystal clear. Furthermore, expenses also deserve their moment in the spotlight. Businesses incur various types of expenses, and it's important to categorize them. We have direct costs and indirect costs. Direct costs are the expenses directly related to producing goods or providing services. They can be traced back to the products we sell or the services we offer. For instance, if we sell physical products, we might call these costs cost of sales or cost of goods sold. If our business revolves around services, we could refer to them as cost of services. It's all about clarity and making the income statement an easy read. Now let's shift our focus to indirect costs, also known as overheads. These are the expenses associated with running the business as a whole. They cannot be directly attributed to the production of goods or provision of services. Overheads can include fixed costs like rent, employee salaries, insurance, administration expenses, legal costs, accounting fees, marketing expenses, depreciation, and amortization. Phew! The list can be quite long. These costs tend to remain stable and don't change with the level of sales. And here's more to overheads. Some of them can be variable, meaning they fluctuate with the level of business activity. These costs indirectly relate to sales and can include expenses like advertising costs, which indirectly drive sales or sales commissions. In a manufacturing business, utility costs may increase as production ramps up. It's like navigating a labyrinth of cost and finding the key to understanding a business's financial performance. If you've liked the video so far, please give it a like, subscribe, and let us know in the comments what you would like us to cover next. Now back to the video. Now that we've explored the intricacies of revenue and expenses, let's unravel the mystery of gross profit. When we subtract direct costs from total revenue, we reach this pivotal figure. Gross profit is a valuable metric that allows us to measure the efficiency of a business's production and sales processes. It's like a compass guiding us through the intricate world of profit. Moreover, indirect costs still await us. When we deduct these overheads from gross profit, we arrive at the captivating realm of operating profit. Operating profit showcases the net income generated from the core operations of the business, considering both direct and indirect costs. It's like peering into the heart of the business and understanding its financial pulse. Now, let's take a moment to reflect on the true power of the income statement. It serves as a tool for evaluating a business's financial health. But how does it accomplish this monumental task? Well, it does so by providing us with the means to compare our financial performance against different accounting periods. These comparative periods can be as diverse as the current month versus the previous month or this year compared to the previous year. By examining the changes in each line item across the income statement, we embark on a thrilling journey of analysis. As accountants, it's our duty to support these movements with a compelling narrative that explains all the differences observed. It's like uncovering the hidden secrets behind the numbers and transforming them into a compelling story. Let's put theory into practice and bring some numbers into the mix. Imagine a fictional company and we compare its income statement year on year. We find that sales have increased by $10,000, but to our surprise, the gross profit remains unchanged. This revelation sparks curiosity and prompts us to dig deeper. To shed light on this mystery, we calculate the gross profit margin, a powerful metric that measures the efficiency of production and sales. It reveals how effectively the business has been converting revenue into profit. As we analyze the gross profit margin between the comparative periods, we start asking important questions. Did the increase in sales come at the expense of selling products at a discount? Or perhaps the cost of raw materials has soared? These questions unravel the threads of the financial story, empowering us as accountants, investors, or small business owners. The income statement offers a treasure trove of business metrics that we can use to analyze and understand financial performance. Gross profit margin is just one of them. If you're eager to explore more of these metrics, just let me know and I'll be more than happy to create videos dedicated to each one. Well, there's still more to discover. Our journey through the income statement unveils other aspects, such as interest expenses and taxes. These aspects find their place below the operating profit, as they fall outside the scope of normal business operations. By subtracting interest expenses and taxes from operating profit, we finally arrive at the holy grail of the income statement, the net profit. Is the bottom line the ultimate outcome of a business's financial performance? To recap, we've discovered the significance of income statement as a tool for measuring a business's financial performance. From understanding its structure, including revenues, expenses, gross profit, and operating profit, to exploring the power of comparative analysis, we've gained valuable insights into how the income statement tells the story of a company's success or struggles. By analyzing metrics like gross profit margin and delving into the nuances of direct and indirect costs, we've uncovered the secrets behind a business's profitability. Armed with this knowledge, we are now equipped to navigate the financial landscape with confidence and make informed decisions. So let's continue our exploration of the financial world, one statement at a time. And there you have it. The income statement, with its intricate layers and captivating numbers, provides a comprehensive picture of a business's profitability. It's a crucial piece of the financial puzzle, working hand in hand with the balance sheet and cash flow statement to complete their narrative of a business's financial health. How do you think understanding the income statement can benefit you in your personal or professional life? Don't forget to comment below with your thoughts, questions, and accounting victories. And make sure to hit the subscribe button and turn on notifications. So I'll see you in the next episode of Counting Coins. Happy accounting!